My name is Phayre-Mudge and I'm the fund manager of TR Property Investment Trust. I've actually been involved with the trust since 1997, so a very long time ago. I took over from my predecessor in 2012, Chris Turner. But actually I started my career as a surveyor in 1990 with Knight Frank and Rutley. So I'm as old as the hills, but have really been involved in both the real estate market and then subsequently switching really into real estate equities towards the end of the 90s. So and then we run a number of other products beyond the trust, but the trust is very much the mothership. So the trust its mandate is to invest in pan-European real estate equities, but also it can have some exposure to commercial property, physical property in the UK, and that can be up to 15% of our assets. Currently it's around 7%. As far as the split in equities is concerned, it's generally about 35% UK and the rest is continental Europe. So we are very much a pan-European animal, and that's really part of its strength, the ability to diversify across lots of jurisdictions, lots of sectors in lots of markets. Well, being an investment trust, we're very fortunate to be a permanent capital vehicle. So that allows us to take a very long-term decisions, particularly in smaller companies. If you run an open-ended fund and you get a big redemption, then of course you'll find yourself trying to liquidate these names at the wrong time in the cycle. The great thing about investment trust, of course, you don't have to do that. So I would say that part of our investment style and something that differentiates us from other people is our exposure to a lot of small companies that we have been over many years have either helped grow or we've benefited from them being actually taken private. In terms of our investment style, I would describe it as essentially growth. We tend to favour real estate stocks that we are confident about earnings growth, but we're always trying to find the situations where the market is undervaluing that growth prospect. We invest in a lot of alternative sectors as well, and we take quite large negative positions in terms of avoiding, for example, between sort of 2012 and 2020, we really avoided UK retail, and then right now we're avoiding secondary office markets almost entirely. Well, we're a big team. There's 12 of us in total, although we're covering other funds as well. But I have a UK and Swedish analyst. I also have an analyst covering the continent, ex-Sweden. So we do a lot of our own bottom-up research. I've been doing this a long time, so we have a very deep knowledge of a lot of our companies. And there are about 100 companies across Europe that we look at, and we have our own detailed bottom-up analysis on about 92% of those by market cap. So generating an idea, we're really running our own forecasts of NAV, of earnings. We're looking very carefully at the debt structure of these businesses, but we're also playing a relative game. So we're looking for best-in-class names within particular subsectors, be they European shopping centres, industrial, UK retail, etc., self-storage. And remember, we're there to beat the benchmark. Our benchmark is the FTSE EPRA Nareit Developed Europe, so it's a basket of pan-European real estate equities, which an investor can of course buy an ETF of that benchmark. But if you invest with us, you're getting that additional alpha. And over the last 12 years, we've generated about 400 basis points per annum after costs of alpha. i.e., and when investors say to me, well, Marcus, who are your competitors? I always say, well, it's the ETF, because investors can easily buy the tracker. But the reason for buying us would be that we've been reasonably consistent at generating that alpha, and that's really all about our stock selection. Well, our financial year to date, so our year end is the 31st of March, so to give you the numbers that are live, we're up about 8% in terms of our NAV growth. Benchmark's up about 3.8. So we're quite significantly ahead of the benchmark at the moment, but that obviously comes and goes. Over a 3 and 5 year view, actually because we had the very poor performance in absolute terms last year, the market was very negative as the cost of capital shot through the roof, and actually our benchmark returned about minus 34 over that year. That has affected, sort of contaminated as it were, the 3 and 5 year numbers, which are both about minus 11%. But the benchmark performance over those two periods are minus 19 and minus 26. So we have, as I said, generated significant alpha over those periods. But looking forward, which is the important thing, we really feel we're at an inflection point now. And certainly the narrative around peak rate is very much one that's chiming strongly with us. And when you look at what's happened in previous cycles, going back to the 1990s, when interest rates have hit a peak, real estate equities have outperformed strongly relative to other equities in the subsequent 3, 6 and 12 months.